The phrase passive income has been so thoroughly commercialized by get-rich-quick marketing that it carries a lot of skepticism, and some of that skepticism is warranted. The reality is that almost all passive income requires significant upfront work, capital, or both before it becomes truly passive. Building a rental property business, creating a dividend portfolio, writing software that generates ongoing sales. None of these are truly hands-off from day one. But the core idea that you can build income streams that do not require trading an hour of your time for an hour of money is real and achievable for most people with the right foundation. The goal is not magic. It is building assets that work when you are not working. The most accessible form of passive income for most investors is dividend income from stocks and funds. Many companies distribute a portion of their profits to shareholders quarterly in the form of dividends. A broad index fund like the S&P 500 yields approximately 1.5 to 2% annually in dividends, which on a substantial portfolio produces real income without selling any shares. Dividend-focused funds can yield 3 to 5%. Real estate investment trusts, known as REITs, are required by law to distribute at least 90% of taxable income to shareholders, making them one of the highest yield publicly traded asset categories. All of these are accessible to anyone with a standard brokerage or retirement account. Rental income from real estate is perhaps the most widely understood form of passive income and one of the most effective at building long-term wealth, because you benefit from both ongoing rental cash flow and the long-term appreciation of the property value. However, it is only partially passive. Landlords deal with maintenance, tenant issues, vacancies, and property management. Using a property management company makes it more passive but reduces the yield. Real estate investing also requires significant upfront capital for a down payment and carries risks that stocks do not. Properties are illiquid, concentrated in a single location, and require ongoing maintenance spending. For many people, REITs provide the economics of real estate exposure without the operational complexity. Beyond dividends and real estate, there are several other legitimate passive income streams worth understanding. High-yield savings accounts and certificates of deposit, CDs, pay interest on cash balances, which in higher interest rate environments can be genuinely meaningful. Series I savings bonds, issued by the U.S. Treasury and indexed to inflation, have periods where they pay very attractive rates. Covered calls, an option strategy where you sell the right to buy shares you already own at a set price, can generate additional income on a stock portfolio, but requires understanding options mechanics. Peer-to-peer lending platforms allow you to lend money to individuals or small businesses for interest income, though with higher credit risk than government or corporate bonds. Digital products represent a genuinely scalable passive income category that has emerged in recent years. An ebook, an online course, a software tool, a Notion template, a photography preset pack. All of these can be created once and sold repeatedly without additional effort per sale. The upfront work is real and substantial. Creating something worth paying for takes real skill and time. The distribution infrastructure also requires setup, a website, an email list, a marketing channel. But the economics of digital products are genuinely attractive because the marginal cost of delivering an additional copy is essentially zero. This is why the creator economy has exploded. The infrastructure now exists for individuals to build meaningful digital income streams. Building passive income is a long-term project, not a weekend project. The most reliable path for most people starts with a high-yield savings account for the emergency fund, then moves to maxing out tax-advantaged investment accounts, 401k and Roth IRA, filled with broad index funds that generate both dividend income and long-term growth. As the portfolio grows, the passive income it generates grows alongside it. A $500,000 portfolio yielding 2% in dividends generates $10,000 per year without selling a share. $1 million portfolio at 2% generates $20,000 per year. This is how financial independence actually works. Not through a single clever scheme, but through consistent investing that builds an asset base large enough that its returns cover your expenses.